Hello, everyone. My name is Neil Ross. I'm Managing Director, National Sales with Ninepoint Partners, and we're very excited to invite you to our webinar on Web3, entitled Web3, The Next Opportunity. And this presentation is prepared by Ninepoint's Digital Asset Group, an important part of what we do here at the firm, and of course, led by our featured speaker, Alex Tapscott, who I'll hand things over to in just a moment. So I think with any meeting, it's important to have an agenda as far as what we intend to accomplish, and we have a fairly ambitious one today, but we'll endeavor to keep on time and give you an opportunity to get a real handle on what we're doing here and why it's something you should be looking at for your clients. And without further ado, I'm going to hand things over to Alex. Alex, again, as I said, is the group head for our digital assets group, and we'll take you through the rest of the presentation. Alex, please go ahead.
Well, thank you, Neil, for that terrific introduction, and thanks everybody for joining us today. I'm looking at the attendee list, and wow, quite a turnout. So lots of curiosity and interest in this subject and this product. Thanks for everybody for taking the time. I'm really excited, for one, to be presenting to you all today, and I'm excited in general about where we're at as a civilization or as a species. And that's because we're on the brink of what I view as a second digital age. So, the first digital age brought us the PC, the mini computer, the mobile web, the internet, cloud computing, and so forth. And now we're at this stage where technology is, it's all around us. It's ubiquitous. Once in a while, a new technology arrives on the scene that transforms the economy and society in some profound and unexpected ways. And we're at this really kind of interesting stage where there's not one, but 6 or 7 technologies that are all kind of emerging right around the same time. A lot of them are, overnight success stories, decades in the making, like say AI, artificial intelligence, which as a topic has been around for decades, but more recently has hit the mainstream with large language models and ChatGPT. Generative AI is helping us to really reimagine what we thought possible. Computers are no longer things that just do raw data processing. They can be creative, intelligent, even funny, and they can augment human behavior in some pretty important ways. The Internet of Things, IoT, this idea that billions or trillions of connected devices will make up the new digital infrastructure for our connected future. Autonomous vehicles, which are hitting the mainstream only now that everyone's kind of forgotten about them in places like San Francisco, and I expect they'll be rolled out nationwide pretty soon. I have 2 kids under the age of 4, and I think if they get a driver's license, it'll be for the same reason that someone today might learn to ride a horse, which is as a hobby. Distributed energy, new technology in our bodies, even virtual reality, again, an overnight success story, decades in the making, seems to be hitting its stride with the introduction of Apple's Vision Pro. So each of these technologies is going to have a big impact, but there's one in particular that I think is going to have a greater impact than any other, and is actually going to help to enable this second digital age. And it might surprise many of you to learn that it's the technology behind Bitcoin, and it's called blockchain. So I've been at this for some time, and I'll tell you a little bit about my background and bona fides in this space. But I'm basically convinced that blockchain represents really nothing short of the second era of the internet. Let me explain what I mean by that. You see, when you use the internet today to send and move and access information, you're not actually sending an original, unique thing. You're sending a copy. Now, for most kinds of information, that's okay. In fact, it's kind of like one of the big benefits of the internet. If I have an email, I want to send it to one person, I can send it to lots of people. I can host a website, anybody can see it. If I tweet something, it's available for everybody to read and comment and retweet. So it's kind of like we all have our own printing press for information. And like the first era of the printing press, overall, the internet has been an extremely positive innovation. But when it comes to things that have value, things like money or stocks and bonds or titles and deeds or property, art, collectibles, even votes, being able to send copies is actually not such a great idea. So instead of having an email I wanted to send to someone, if I wanted to send them some money, it's important that they know they have the only version of that money and that I can't send the same money to someone else. Because if I can send the same money to someone else, then that money becomes worthless, right? So even though the internet has changed how we consume content and democratized publishing for users, it actually hasn't had as big an impact on value-based industries, on commerce, as I think a lot of people had hoped for. And that's because when you use the internet to do business or transact, you still basically rely on middlemen and increasingly platforms, big technology companies, and they perform essential roles in the economy, both online and offline. They establish identities: who's the buyer, who's the seller, who's the sender, who's the receiver. They perform all the business logic, clearing, settling, record keeping, contracting, and they establish trust between parties. And for doing so, they get rewarded. Now, overall, these intermediaries do a pretty decent job, but they have some big sort of limitations. They're centralized, which makes them vulnerable to hacking or to attack or to capture by corrupt governments, which we've seen in some parts of the world. They add friction and slow things down. In the case of international money transmission, it can cost, on average, 9% to move money between two individuals on opposite sides of a border and take days or sometimes weeks to settle. Even in more sophisticated elements of finance, we still settle transactions T+3 on the stock market, and transactions and credit cards take days to settle for merchants. So there's a friction and a cost associated with this as well. They exclude big parts of the population. There are about 1.5 billion people who don't have access to financial services. About another half of the population doesn't have a way to represent their digital identity. And that's a big problem because it prevents those people from participating in the global economy. And then the big issue is that all this value that's created from being an internet user, the data that we create, the engagement, the clicks, the likes, the attention, gets captured. The value gets captured and gets resold to us in the form of advertising. So what if the internet were entering a new era, from an internet of information to an internet of value? Well, in 2009, an anonymous person or persons named Satoshi Nakamoto outlined this thing called Bitcoin. And basically, it was designed to be cash for the internet, a way to move value peer-to-peer without the need for a third party like a bank. And what was really remarkable about Bitcoin was that it employed this novel invention called a blockchain. The blockchain basically replaces the need for a centralized database or intermediary with a decentralized database. But the really remarkable thing about Bitcoin was that it actually worked. There had actually been several attempts in the past to figure out a way to create money for the internet. The predecessor to PayPal, X.com, started by Elon Musk. That was their original idea. Mark Andreessen wanted to put a digital money payment tool inside the first web browser. Even Bill Gates was talking about the need for digital money way back in the 1990s. But none had figured out the double spend problem, this idea that when you move something of value, how do you ensure there's only one of a kind? And Bitcoin solved that problem. And most importantly, it worked. And because it worked, it set off this spark, which has really caught on like wildfire and captured the imagination of people who are seeing blockchains as a new tool to not only reimagine assets, but maybe reimagine the web. So as the blockchain world evolves into Web3, it's helpful to really understand kind of what came before. So I talked about the internet of information and the internet of value, but it's important to understand that the internet and the web are technically two different things. The internet itself was originally invented in the late 1960s as a project that was funded by the Department of Defense in the US. And the reason that they did this is because they wanted to build a decentralized communication network that would stay up and running in the event of a nuclear attack by the Soviet Union. At the time, all communications went through one central routing station. So they wanted to build something more resilient, something more decentralized. But it wasn't until the invention of the World Wide Web and later the web browser in the 1990s that the web actually became a commercial tool, that it became something that regular people started to use and businesses started to use and deliver and build services on top of. The first era of the web, what we think of as the .com era, really began in the 1990s with the invention of the browser. And indeed, the browser is sort of how we access Web 1, which is why it's called the .com era. That's how a URL ends, right? And the first era of the web was really a presentation medium. It was a way to consume content. Anybody who remembers going online in the 90s, you'd log onto a website, you'd be able to see some content, read the news, check out the classifieds, access the sports scores, search something in the Britannica online. It was really a medium for information, a way to consume content. Over time, the combination of technology tools advancing, but also the .com crash sort of spurring on the need for something new, led us to the second era of the web, what we consider the read-write web. So in the read-write web, not only can we access content online, we can actually start to use the web as a tool to upload our own content, to create communities, to collaborate, to share. And the defining businesses of Web 2, are by and large businesses built around user-generated content. So social media, for example, companies like Facebook, as well as companies that took advantage of the mobile web. So companies like Uber, for example, and Airbnb. And Web 2 is an important step forward because if Web 1 democratized access to information, then Web 2 democratized publishing. So everyone could be a photo blogger and a citizen journalist and an amateur scientist and post their findings online, for better and for worse sometimes. But the idea was that we had a new tool to publish information and collaborate. However, the big limitation of Web 2 is that all this information that users created and shared online, they had no way of really monetizing it. There was no way to represent it as a digital asset. And so as a result, it was captured asymmetrically by a handful of big platforms that built walled gardens, kept users in, and then extracted as much data as they could. In the end, what ended up happening is that the killer app, or the main business model of the web and Web 2, became advertising. And advertising today still remains the biggest driver of revenue for many internet companies. So now the web, and with it the internet, are entering a new era, what we call the read, write, own web. So not only is the web a way to access information, not only is it a tool to publish content, but it's actually a new set of tools that allow us to express ownership of digital goods. So that can be our data, it can be our identities, it can be the virtual assets that we buy inside of video games and other online services. It can be our financial assets, it can be money, it can be parts of our identity and reputation, it can be concert tickets, really anything of value can now be expressed using the new toolkit of Web 3. Web 3 is going to transform business models. It's going to, I think, usher in some, radically different kinds of companies and projects. It's going to displace a lot of leaders of the old paradigm. Like other eras of the web, it will become a foundational technology for business, and it's also going to become a very compelling frontier for investment. I'm going to skip ahead. So in Web 1 and Web 2, we think of ourselves as internet users. You are users of a platform, and you provide the data to the platform, and in exchange, you receive the service. That is a bargain, a trade that we have implicitly made for the past 20 years, that in exchange for our data, we are going to get access to some services. I think a lot of people increasingly view that as kind of a raw deal. They realize there's a lot of value getting created. They're not participating in it. And we have a lot of concerns about how that data is being used and if it might undermine our privacy. So the big shift today for Web 3 is a shift from being an internet user to being an internet owner. Another thing that's changing is the underlying hardware interface, the way in which we actually access the web. So every 15 years or so, there is a hardware upgrade that changes the way in which we interact with technology. So, in the 1990s, everyone kind of had a home computer, right, in their den or in their family room, big giant desktop. And that was how we had a 56 kilobit modem that was connected to your phone line. Remember that noise? And you would type in a website URL into a web page, and then you would actually see content, and you'd consume that content, you interact with it, but it was pretty static, right? That's Web 1. The browser was the main way we accessed Web 1. With Web 2, which came about in the early 2000s, we also had another revolution happening, which was the smartphone revolution. So really, when we think of the big killer apps for Web 2, the social web, the way in which we interact, at least I think of smartphones. So every 15 years, a new technology upgrade. With Web 3, we interact with Web 3 in one way already, which is with wallets. If the browser is to Web 1, what the wallet is to Web 3. The Web 1 is a way to store information, Web 3 is a way to store value, then your wallet is how you hold digital goods, whether it's collectibles or money or what have you. But there's another trend that's happening right now that intersects with Web 3, and that is the rise of virtual and augmented reality. For 34 years, even through Web 2, the web has always been two-dimensional, but what virtual and augmented reality promises is the potential for a spatial web is integrated into our natural environment that augments and improves it, or perhaps a space that we enter that is distinct but three-dimensional. So this is something that's also trending at the same time and is part of our focus area as managers. Another driver of growth is the tokenization of assets. So I think there's a lot of misinformation and confusion around tokens, right? We hear about cryptocurrencies and things like Bitcoin or Ethereum and others. And a lot of people ask me, and I think the question is totally justified, why do we need hundreds or thousands of different currencies? We've got, a system today where different nations each have their own currency, and that doesn't seem to work that well. There's a lot of friction. Some of them are not that liquid. It kind of adds a lot of complexity to the economy, maybe needlessly. And my answer to them is, you're probably right. We don't need tons of currencies. But the good news is that tokens are not currencies. A token is just a container for value, in the same way a website is a container for information. So a token can be programmed to represent anything of value. It can be a currency, to be sure, but it can be a stock or a bond. It can be a piece of art. It can be a bespoke agreement, between two parties. It has a special identifier, like sort of like a wet signature. It can be a digital representation of a physical asset, something like a carbon credit, for example, or gold, or some other asset, or something we haven't necessarily thought of. I've developed this tokenization taxonomy only because it's helpful to understand that cryptocurrencies are one of many different kinds of assets. So I talked a little bit about this second digital age and all these technologies happening at once. We have to ask ourselves, in a future where there are 8 billion people, countless businesses, smart AI agents that are autonomous, moving around, doing things on our behalf, billions or trillions of connected devices, all needing to do agreements with each other to transact, to store and move value, not to mention new kinds of digitally native organizations, all working together online to move the economy forward. If we imagine that to be the way we're headed, an economy that's truly digital, then the way we're going to do commerce is not with banknotes or checking accounts or wires. It's probably not even necessarily with traditional financial intermediaries or with existing technology platforms. What we need is a new operating system for commerce. And Web3 is ultimately going to become an integral technology for business that is going to enable a lot of the capabilities that I've described, and in the process, transform business models. There are going to be winners and losers in this era. A lot of the value in Web3 won't necessarily accrue to companies, or at least not companies alone. There are platforms, things like Ethereum and Bitcoin, which today are already worth billions of dollars, that I think will continue to thrive and to succeed in an era where more and more economic activity is happening inside those systems. But I also think that there are companies who have staked their fortunes on Web3, who, if they can endure the current uncertainty in the market, are going to come out on the other side as, potentially the next generation of world-winning companies. And of course, there are existing companies in the world today who could potentially be disrupted by this technology. And there are others that could be enabled by it or empowered by it. I think it's important to look at investing through the lens of history, because if you look at the first era of the web, in the 1990s, there were lots of different kinds of companies that people were convinced were going to be successful investments. Companies like Kodak, Borders, Polaroid, Blockbuster, JCPenney, Macy's, even America Online, this new technology company. And what every single one of those companies had in common was that they were actually about to be disintermediated or disrupted by the open internet of Web 1. And they were companies that failed to adapt to change. Now, everything's easy with the benefit of hindsight. But if we use a Web 1 lens to look at those companies today, we realize that they were actually all kind of standing on a burning platform. Now, today, I think there are lots of companies we can look at in the public markets that a lot of people are convinced are going to be hugely successful, continue to dominate in their respective field. And some of them may, there are a few big companies that I think are really well positioned for this future, but there are others who are not. So this time, I think it's important not to let your guard down and to be diligent and to understand how this new technology is going to change, not only how it's going to not only enable new kinds of companies that will be successful, but what kind of impact it's going to have on incumbents in the market today. So there's several themes that we look at when we're examining investments. The themes that I'm really interested in are sort of laid out on this slide. So number one, infrastructure. Platforms like Ethereum, for example, are foundational to this new Internet of Value. Ethereum is not a cryptocurrency like Bitcoin, it is a platform. And the more applications that get built on that platform, the more value accrues to the platform. Because in order to run applications on those networks, you need to pay in the native token, which sounds kind of convoluted, but it's really not. It's basically, if you've got a CRM system with Salesforce, or you pay Apple or Amazon Web Services for cloud services, the more seats you have, the more storage you need, the more you pay, right? So the more applications are developed on Ethereum, the more valuable that network becomes. Infrastructure is core to what we're doing. NFTs, a lot of people think of NFTs as being associated with art, and they are in their early stages. But NFTs are unique digital assets that can represent anything of scarcity. So it can be art and collectibles, but can also be any financial contract that is unique in nature, right? So a mortgage on your house is actually completely unique. And the terms of that mortgage can be programmed into a digital asset and represented as an NFT. So the innovation frontier for NFTs is massive, not just in art, but in finance as well. Gaming in the metaverse. This is, to me, a big opportunity that we already have ample evidence that will continue to grow. So right now, every single year, people spend about $100 billion on virtual goods and services that they don't actually own in the traditional sense. So, if you purchase Robux in the Roblox game, or, you've got a kid who plays Fortnite and buys a skin, that's a digital asset that they've purchased, but they typically can't take those assets out of the game. They can't sell them peer-to-peer without at least paying some money back to the service. They can't custody them and own them in the truest sense of the word. They have no digital property rights. But what blockchains enable is for us to imbue digital goods with property rights. And so I think that gaming and sort of interactive entertainment is this huge untapped field of innovation where this technology will come to play. On the enterprise side, a lot of very smart and innovative companies understand, as with previous eras of the web, that Web3 creates new ways to connect with customers, to open new markets, to build products that weren't previously possible. There are a lot of businesses that I would describe as pick and shovel businesses, in the same way that railroads and telegraph companies and even Levi's that made jeans were huge beneficiaries of the gold rush of 1849. There are a lot of these ancillary businesses that are sort of nearby the innovation, which are going to benefit significantly, exchanges, neobanks, and so forth. And I think that finance and payments is going to be completely reinvented using this technology. We already have ample evidence of stable coins being used to clear and settle trillions of dollars of transactions on the Ethereum network. Platforms like USDC and USDT allow people anywhere in the world to move and store value in dollars. And I think that's something that is going to have a big impact on financial services. So those are some of the big themes in our overall philosophy. So why Ninepoint and why the Web3 Innovators Fund? Well, for starters, it's a very convenient way to get exposure to Web3. This is an ETF that trades on the Toronto Stock Exchange. It has a 70 basis point fee and a 1.45% NER. Anybody can buy it. You can create units or redeem units very easily. So it's just a very convenient and easy structure to get exposure to this. Number two, there's a growing investment universe. Every year, every month, every quarter, there are more and more companies that are either embracing this technology or using the public markets as a way to list and raise capital. And so that acts as a huge tailwind for us, that there's just a growing investment universe. Number three, and I think I've made this clear so far, but digital assets are foundational to Web3 and are also foundational to this strategy. I'm a big fan of Bitcoin, but I'm also, I think you can tell, a big fan of Ethereum. Those two assets together represent, I think, about 65 to 70% of the total market value when you strip out stablecoins. So they are the dominant platforms. They do different things. Bitcoin is a store of value and a medium of exchange. It's money for people who can't access financial services or who live in places where the local currency is unreliable or super inflationary, which is why Bitcoin is very popular in Venezuela, Nigeria, Turkey, and elsewhere. Ethereum is a platform that allows you to build and scale new kinds of peer-to-peer applications across a range of industries, everything from infrastructure to art to financial services. So both of these things, they're not competitive with each other, they're complementary. And I think they're both expected, and we believe that they will continue to grow in size and importance. The fund also provides exposure to enterprise adoption of Web3. Plenty of almost every thoughtful company that we've looked at, good innovators have some kind of Web3 strategy. That doesn't mean they automatically fit into the investment universe. If someone is testing something out, it may not have an impact on their business for a while. But there are several big companies where Web3 is becoming foundational to their business. We believe we're uniquely positioned in Canada. As a group, Ninepoint is a leader in the alternatives field. We have $8.5 billion in assets under management and institutional contract. We believe that alternatives are a key part of a well-balanced portfolio. This fund, I believe, is something that fits both into the growth equity and into the alternatives category because it is unique in straddling digital assets and equities. And we have experience. We have experience in alternatives, but also we have experience in Web3. We've been at this for several years. And as I mentioned, almost every single technology, payments, most smart consumer facing companies have all done substantial work in this area. And we expect over time Web3 will become an increasingly large contributor to their business, just as you could say that the web has become foundational to plenty of other businesses we wouldn't necessarily consider technology companies today. So how do we think about the portfolio? Well, broadly speaking, we look at it in three big buckets. So number one is crypto asset exposure, which we gain through low-fee Canadian listed ETFs that own both Bitcoin and Ether. That part of the portfolio is something that we expect will always be the anchor of our investment strategy. Number two is what I would call pure play Web3 businesses. These are companies that, as I said, have sort of staked their fortunes on the growth of this asset class and then the technology becoming more widely used. And then the third I would describe as beneficiaries of the transformation or end users of the technology. That's a group that today is growing quickly and we expect is going to continue to grow as well. So to give you a sense of a target category weighting, and we've only been at this for about 9 days since we launched the fund, and we appreciate all the interest already so far. But roughly speaking, we want to keep some cash on hand, keep our powder dry in case there are opportunities to take advantage of moves in the market. But in general, we view this as sort of three legs to the stool of what we're trying to do. I've talked a little bit about Bitcoin. I wouldn't mind just drilling down on Ethereum. I know there are lots of people here who probably know about Ethereum. I know that we're a mostly Canadian audience on this call, and it's worth just talking about Ethereum for a moment. So I often ask people, what are the most successful businesses or enterprises to come out of Canada? What's the most successful sort of business entity? And a lot of people will say, I don't know. Was it Nortel? Is it RIM? Is it Royal Bank? Shopify? That's a big company. And the answer to that is it's actually Ethereum. Ethereum has a market cap today of 220 billion, which last time I checked is, I think, almost double the market cap of Royal Bank. It was founded by a group of Canadians working in Toronto, led by one person in particular, Vitalik Buterin. Since then, the Ethereum has become fully decentralized, has no ownership or leadership per se. But the group that sort of came up with the concept was Canadian. And there's a different conversation topic, which is what we could have done to keep Ethereum here. But today, Ethereum is the dominant platform for a lot of interesting areas of Web3, NFTs and cultural industries, decentralized finance. So, a lot of new financial applications. In many of these areas, it is dominant. Now, it's an interesting and compelling investment for a couple of reasons. One is, you know, it's the dominant platform. It's got 70% market share if you look at sort of total value locked, for example, in DeFi. And the same way that certain operating systems have, you know, dominant market share in the smartphone category, that makes them very valuable. And similarly to, you know, a smartphone operating system like, say, Apple, the more applications that get built in the Apple App Store, the more valuable Apple becomes because of the lock-in effect of being on that platform. And the same thing is basically true for Ethereum, right? The more applications that get built on Ethereum, the more demand there is for the native token, the more value accrues to the platform. So that's the sort of fundamental driver of growth on Ethereum. But there's another more subtle thing that a lot of people are not really aware of, which is that last year, Ethereum underwent a massive technological transformation where it basically moved from one system of security known as proof of work, where large amounts of energy are used in order to secure the network, to a different method of security known as proof of stake. That process reduced the carbon footprint of Ethereum by 99%. So that today, Ethereum really doesn't use more energy than any data center doing any other function. That's important for a couple of reasons. One reason is that a lot of large enterprises who maybe otherwise would have paused when looking at building on a platform that uses a lot of energy are now looking at it and saying, you know what, this meets our goals on ESG, this meets our goals you know, on climate, and so therefore we're totally comfortable building. And through our channel checks and talking to some of our portfolio companies, we know that there's been a groundswell of interest from enterprises over the last 9 months since this happened. But the other thing that happened around the same time is that Ethereum introduced this new change. And basically, it's very simple. Every time there's a transaction on the Ethereum network, network user pays fees. Now, part of those fees are taken and used to basically buy and then retire ETH that's outstanding. So in the same way that Apple might use its excess earnings, what it doesn't, you know, reinvest in the business, to buy back stock and reduce its float, Ethereum, the network, is actually taking a portion of the fees and using, like its earnings, and using that to retire ETH. So a lot of people talk about Bitcoin as being sound money, digital gold, and in many respects, it is quite similar to gold. But in one respect, Ethereum is more like sound money than gold. Since September, over $6.5 billion of new Bitcoin has been created as a result of the process by which Bitcoin operates. By contrast, in that same period, over $500 million of ETH has actually been removed from circulation. Now, we're not talking about the market value, which can go up and down, of course. We're just talking about the amount of actual number of tokens times price that have been taken out of circulation for good. So in the same way that, you know, Apple can grow its earnings per share without necessarily growing its earnings because it's retiring stock, Ethereum similarly can see value accrue to token holders just through this mechanism. It also is helpful that it's the most wildly popular platform in Web3 today. So that's why we view Ethereum as a core, you know, piece of our portfolio. Another topic that's very relevant to the fund's strategy, and which has received a lot of attention in the last couple of years, is this idea of the metaverse. Now, you know, it is certainly a topic that has been hyped by some, but I think a lot of really thoughtful people agree that the economic opportunity of the metaverse is very significant. So Morgan Stanley said in a recent report that the total addressable market is around $8.3 trillion. And similarly, Citibank thinks that it could be potentially as high as 13 trillion by 2030. Now, you might wonder, what exactly does that mean? Well, in the last few years, the amount of time that we as human beings have spent online has increased significantly. Now, it's gone from you know, desktops to mobile, and the potential future is one where we're, you know, in augmented reality, virtual reality, or some kind of spatial computing. So that's trend number one. Trend number two is that as people spend more and more time online, a greater share of their wallet is going to be spent on internet services and on digital goods. And we know this to be true just by looking at how young people spend their time and spend their money in video games, in virtual worlds, and so forth. So in an environment where more and more people are spending time online, and a greater share of wallet spend is going towards digital goods and services. And with a new technology that allows us to actually represent property rights and to own assets, then we think that that acts as a huge tailwind for innovation and investment. So there are several video game studios, publishers who have embraced this technology, and we expect that that is going to accelerate over time. So how do we compare? Now, it's not an apples to apples, but there are lots of different funds that offer exposure to Web3, digital assets, and so forth. Well, where we think we're different is that we are a low-fee ETF, traded on a major global exchange, the Toronto Stock Exchange. We provide exposure to Bitcoin, but we also provide exposure to Ethereum and to our investment strategy of public equities, which includes both pure play as well as the beneficiary businesses. So taken together, we think we're offering something that's quite compelling and rather unique in the market. Of course, as with anything, there are risks. We ask that you please refer to the simplified prospectus for any additional risks associated with the fund. Why Ninepoint? Well, I think everybody knows a little bit about our firm, but we are a leading Canadian alternative investment company with over 8.4 billion in AUM and institutional contracts, headquartered in Toronto, Ontario, with 100 employees. We target investment strategies that are uncorrelated from traditional asset classes with the goal of lowering overall portfolio risk. We also strive to be innovative, to do things differently, to be a value-added partner when it comes to investments in the long run. And we have a long track record of managing alternative income real estate and alternative core strategies. So taken together, this is the kind of firm that is well positioned to be a leader, to be an innovator, and to do something new like the Web3 Innovators Fund. In terms of key people on the fund, I'm the APM. John Wilson, our co-CEO and managing partner, is the portfolio manager. He and I work closely together, along with our associate in the digital asset group, Jake Moody. If you'd like to meet those people, we'd be happy to set it up. So again, fund details, it's a pretty standard issue. We've seen that before. Now, I would love to hand it over for a Q&A session, and I think I will let Neil take it from here. Neil, go for it.
Thank you, Alex. And I would say with respect to fund details, that we think with the 70 basis point management fee, it's really attractively priced and that you're getting a lot of value for a pretty reasonable management fee. So we've had a lot of questions. Thank you. It's always an awesome position to be in, and thank you for your interest in this idea. We did have 4 that we've kind of pulled out here that we think would be of most interest to the widest audience. So the first question I've got is, so Alex, how do you think Web3 can change the asset management space?
Yeah, it's a great question. So I think there are 2 ways to approach that. Number one is, I think over time, digital assets are going to be where a lot of value is captured in Web3. So that's platforms like Bitcoin and Ethereum, which we own, but over time could also include other platforms too. So as an asset we're early, obviously, to this, but over time, if you're a growth equity manager or you're someone that wants to capture value in this new internet, then you're going to have to adjust, I think, to owning those kinds of assets or gaining exposure to that. And I think that's a pretty big shift in the asset management industry. The much more profound shift, though, is that because tokens are containers for value, because they are ways to represent value in a digital format, I believe they will come to represent many different kinds of financial assets, securities, stocks and bonds, but I can also see them coming to represent units in mutual funds or ETFs or other kinds of invest products. Indeed, we've already seen this play out on a couple of interesting levels. So, big private equity firms like Bain Capital, KKR, and Apollo, normally reserved for large check size investors, have chosen as a way to democratize access to their strategy to tokenize units of those funds and make them available as digital assets that anyone can invest in. And if you think about the limitations that a lot of investors have to get exposure to investments, sometimes it's a fund minimum, sometimes it's accreditation, sometimes it's just geography. it's very difficult to for people living abroad to even own dollars, US dollars, let alone to be able to get access to US dollar denominated investments. We already have lots of proof that there's strong product market fit for digital assets backed by dollars. They're called stable coins, and they're extremely popular in many parts of the world. So, the first thing people want is a US dollar bank account. The second thing they want is a US dollar investment account. And I can see tokens being a way to globalize a lot of investment strategies. Now, as with everything, there's what's possible with the technology, and then there's what's possible in the context of the business and the regulatory environment. And, if you're not registered to distribute, in a certain jurisdiction, then perhaps you can't do that, right? But I think that, as with anything, if the use case is compelling enough and the technology tools are there, businesses will try it. And as I've mentioned, they already have.
A question about the fund structure. The fund is available as both a mutual fund and a ETF. I'll take that one. Next question, Alex, is what gaps in Web3 need to be closed in order to drive institutional adoption of public blockchains as financial and economic settlement infrastructure? It's an interesting question.
Yeah, it is an interesting question. I'm an optimist by nature, as you can probably tell. And, for me personally, I think, as a human being an optimist by nature is it's a good thing to be. But I'm very open-minded about all of the challenges and the risks that exist in any opportunity, with any opportunity and with any technology. In fact, in the first book that I wrote on the subject, Blockchain Revolution, with my dad, Don Tapscott, we dedicated a whole chapter to risks or implementation challenges and reasons that blockchain might fail. And in this new book that I've written, Web3, which I've just thrown up on the screen here, I revisit a lot of these. So what are the big risks? Well, risk number one, is the technology ready for prime time? Are these underlying platforms like Ethereum able to actually support all the transaction volume that moving settlements in financial assets would bring? That was not the case in 2016, but today, increasingly, the technology is gearing up. How will incumbents react? Will leaders of existing industries that are threatened by this try and fight change? Will they, try and erect barriers to prevent this from happening? How will governments and regulators approach this? Right now, that is a central topic that is playing out differently depending on which part of the world you're in. Right now, the SEC in the US has taken a hard line against a couple of companies that operate in the country. And, we could talk about that at length, but it's quite a contrast to what we're seeing in the UK, where the Prime Minister just said 2 days ago that he hopes to make the UK the Web3 capital of the world, or in, say, the Gulf countries, where they're spending billions of dollars to attract capital and talent, or even in China, which has opened up much more recently to this space. So, governments don't all act as one, and it's very uneven, but that's certainly something that we think about. Lots of technologies have tons of potential, and some of them have regulatory headwinds, and some of them have regulatory tailwinds. And sometimes they work out really well, and sometimes, even though they have huge potential, they don't ever reach their full potential. So a good example of that would be something like nuclear power. So, nuclear power is a carbon-free way to generate energy that could solve our needs and probably, prevent the planet from warming any further. But we don't do it because there's a stigma attached to it because of, 3 Mile Island and Chernobyl. Rightly or wrongly so, that's a technology that actually never reached its potential because of a couple of high-profile stumbles. So, that's something I also think about, which is, even if it's great, will it ever be embraced if people, are skeptical of it? So anyway, that's all to say there are lots of different, reasons why things might not reach their potential. But I always ask myself, are these reasons that the technology's, not worth my time, or maybe, will never, reach critical mass, or are they implementation challenges to be overcome? And I think they're all, by and large, implementation challenges that we should overcome, or at least try to overcome, because the opportunity here to, create new businesses and to improve global prosperity and to improve privacy and to resilience of our economic systems is really significant, and I think we should really give it a go.
Will Web3 enable greater creator control and accountability?
Yes, it will. The name of my new book is Charting the Internet's Next Economic and Cultural Frontier. And the idea of culture is really central. For most of the modern era, technology has been a really great tool for artists, a great enabler of opportunity. So things like the printing press, made it so that there was a mass market in poetry and literature, and that actually helped people get paid. The lithograph helped graphic designers and artists actually sell copies of their work. More recently, records and CDs and the royalties associated with them employed hundreds of thousands or millions of studio musicians, writers, and other people in creative fields. So technology has always been an enabler of commercial opportunity. In the last 20 or 30 years, though, the track record is a little bit more muddled. The internet is this medium for information. And what it did is it basically took something that was an asset, a record or a CD, a physical thing that you could, buy and listen to, and turned it into a free commodity that was churned through the printing press of the internet, through file sharing services, to the point where its sort of marginal value was close to zero. And so what ended up happening in music is that we replaced an old set of intermediaries, labels, with a new set of intermediaries. The labels are still there, but now we have streaming services as well. And now creators are getting paid less than ever before. What Web3 enables is a new toolkit to help artists and creators monetize their work. So a lot of visual artists sell their work as NFTs or as limited prints in NFTs, for example, and there's a bustling market for that. In 2022, for example, there was $25 billion of original and secondary sales in NFTs. So it's quite a significant market. In music, we're seeing artists creating what are called token-gated communities. So in the same way you might go to Ticketmaster to buy tickets to see the Taylor Swift Eras concert, a tour, which is going on right now, you might, as a member of the token-gated community, get early access to those tickets, get access to special cuts of the music or different kinds of material that maybe the average fan wouldn't. So it's basically a way to represent value digitally that's empowering artists to connect more with their fans and to capture more value from their work. And in the process, maybe disintermediate some of the traditional middlemen. So yes, the answer is it is a way for creators to get paid better, more promptly, and more fairly overall.
And just looking at the clock, we're going to try to fit one more in here. Last question is, with the advent of AI and robotics, what would be the effect on productivity, and what sectors would be mainly disrupted? Hopefully not investment fund wholesaling.
Well, I had this idea that we're going to have AI portfolio managers and AI wholesalers, and then there will be AI advisors, and they'll all be talking to each other and creating lots of value, and that will free up everybody to get together and meet in person and build deeper relationships. This is my theory. We'll let the AI do all the grunt work and let the people do the relationship management, which as a salesperson, Neil, I'm sure that resonates with you. I think that when it comes to AI and related technologies, it's too early to say, but I'm pretty convinced that a lot of knowledge work is going to change. Now, there's this idea that AI is somehow going to disintermediate people, that it's going to replace people. That's something that we see that comes up all the time, every time there's a new technology. So when the first mechanical loom was invented in the 18th century, there were a lot of people who were worried that it was going to displace artisan cloth makers. Those people were known as Luddites, and we still use that term Luddite to describe someone who kind of is resistant to change. But what ended up happening actually is with the invention of the loom, the number of people employed in cloth making increased by 4,000% over 20 years. What the technology did was not displace people, it created all sorts of new productivity gains, which led to new value creation, right? And so we look at AI, and people say, well, you can have an AI HR manager and you can have an AI chatbot to replace your call center. And that might be true, but that doesn't mean that the people who, were affected are no longer employable. Maybe it allows them to do something else, or maybe their firm making more money puts them in a better position. So we can't really predict how these things are going to play out. The thing I'm referring to is that it's a fallacy. It's called the lump labor fallacy. It's basically the idea that there's a fixed amount of labor to be done, and if a computer doesn't, then a person won't, right? And what we know from history is that actually, the economy grows, and so there is other opportunities. So I'm not dismissing that. I'm just saying that, if history is any guide, AI is going to be an enabler of human capability, not something that displaces them.
Well, thank you, Alex. I think we should leave it there. I think we had a pretty robust discussion of the area and the investment thesis. For those on the line that like what they heard today and want to take advantage of this fund is currently available. If you visit the Ninepoint website, ninepoint.com, you can get additional information on the Ninepoint Web3 Innovators Fund, fund codes, ETF tickers, it's all there. And if you have additional questions, we are obviously very interested to take the conversation further. If you'd like to have Alex, come visit your branch for branch presentation, we can arrange that as well. And really happy to keep the conversation going. And of course, if you have additional questions, you can also reach out to your Ninepoint wholesaler. If you don't know who your Ninepoint wholesaler is, they are listed on our website. And if you're in a real pickle, you can email me and I'd be happy to put you on the right road, and ross@ninepoint.com. So once again, thank you, Alex. And to everyone who carved out just about an hour of their day to invest here in about this idea, we appreciate your time. All the best.